Hello, this is Jordan, and this video is being recorded on the afternoon of February 17th, 2017. Thank you for joining me today. In this video, I'm going to talk about the importance of a company's capital structure. And by capital structure, we're talking about a company's share structure and its cash or debt. Now, the share structure is the shares outstanding and the fully diluted shares, which include all the options and warrants. And we know that in the junior mining world, companies use warrants and financings quite often. So it's very important to keep track of the fully diluted amount of shares as well. And another thing that we look at is the retail float percentage, which is we're looking at how many of the shares are owned by retail, and those are non-insiders, non-management, non-institutions, and you can get a percentage of that by dividing that by the shares outstanding. And most companies in their presentations, they will show you who owns the stock. They will tell you how much management owns, how much insiders own, institutions, and so in most of those presentations you can get the info and do a quick calculation. And capital structure, it can help us identify immediate red flags. I mean, essentially, we don't want to see a company with a huge amount of shares outstanding. I mean, to me, if something has over 200 million shares outstanding, that's a red flag unless the company is very advanced. I mean, unless it's in the development phase, it's nearing a potential acquisition or production. If it has a lot of 200 or more than 200 million at that point, that's not so bad. But if we're looking at junior exploration companies, I mean, once they start to get, I mean, you're getting to the level of 200 million shares and more than that, it's really a red flag. Now, and if the company has too many warrants that are in the money or close to being money, that's also a red flag. Even though cash will be raised and the enterprise value won't be affected as much as the market cap, having a lot more shares can slow down the appreciation of the stock. And also with respect to the retail float, low insider ownership or low institutional ownership is a possible red flag, because when the retail float of a stock is much larger, that can slow down the pace of a stock's advance. And so let's just do a quick comparison calculation here of two similar companies. In this scenario, we're just looking at two companies. They have the same amount of cash, they have the same amount of shares outstanding, but they have a different amount of fully diluted shares, and their retail floats are different. Now, let's look at company A with the tighter share structure. It has fewer options and warrants. So both companies, let's just say their stocks trade at $1. They have an enterprise value that's the same, 104 million. Now, for company A, if that doubles and goes to $2, and we're also assuming here that the options and warrants are exercised at $1.50, so that brings in lots of cash. But for company A doubles, and when it's at $2, its enterprise value would be 222 million. That's assuming all the warrants or options and warrants get exercised at $1.50, and we're also assuming the cash position. I believe we subtracted 3 or 4 million because obviously it would take time for the stock to double, and the company would have to spend some money to keep itself going, explore, etc., etc. But for company B to double, it would end up with a larger enterprise value because of the extra shares outstanding, the extra options and warrants, which when fully diluted, when that becomes the shares outstanding, in this scenario, you can see that company B would have an enterprise value that's larger than company A. And now, enterprise value, I like using that because that includes cash. If we're just looking at market caps, I mean, there's a much bigger difference. Company A would have a market cap of $240 million. Company B would be $280 million. I did another calculation which had Company A doubling, and in that scenario, Company B rising 78%. But I don't know exactly how accurate that is. So basically, this is just a very short example here, and it's not a massive difference in appreciation, but still, it's enough of a difference where we really have to care. And we're also not factoring in that Company A has a tighter float, based on what we said in this slide, where the retail float is 50% in Company A, and then it's much larger in Company B. So in other words, the shares that are not tightly held, that are in the float, that are kind of actively trading, Company A has a smaller float, fewer shares, so it'd be able to rise faster. And that's also true when you factor in, that's true when we're not even factoring in the extra shares. So that's one thing. And then secondly, you factor in the extra shares that get, the extra options and warrants that become exercised. That also slows down the pace of appreciation for Company B relative to Company A. So to conclude, what we want to look for are tight share structures and smaller floats. Those stocks are going to move the fastest. Now, this is just one thing that we're looking at. I mean, there's many criteria that we're looking at when we're buying and selling companies and deciding which companies should be overweighted and which companies should be underweighted. But this is important because it can tell you which stocks are going to have an easier time rising, which stocks can rise more quickly than other stocks. So it's something that you definitely want to keep in mind with respect to your speculating in the junior mining sector. That's all for today in this video. You can follow all of my work at thedailygold.com. Opt in there for my free newsletter. I send out a weekly update every Sunday morning. You get my most recent thoughts on the sector, as well as some snippets from my premium update, which I send every Saturday evening. And you can also subscribe to my channel here at YouTube. Thank you again for listening and watching this video. I look forward to publishing another video for you in the days and weeks ahead. Thanks.